Hey everybody, welcome back to another edition of 5 Question Friday. This is where I cover 5 of the questions I was asked in past live shows that I couldn't get to. We do a live show generally every other Monday at 7 p.m. Eastern Time. Our next live show, I believe, is January 6th of, can you believe it, 2025. You can sign up to my newsletter. It's a free newsletter I send out every Sunday morning, and I keep everything updated there as to the next live show. I did have some folks saying that they were having trouble signing up for the newsletter, so let me briefly show you that. In every video I publish on YouTube, this is just an example from the last live stream, I have a link down here. Join the newsletter, it's free. If you follow that link, it takes you to my website, and you can see right here, you just put your email address in and subscribe. I don't sell, I don't even know how to sell an email list. No one else gets these emails. And in every email I send out, there's a link for you to unsubscribe if you want to. So that's how you do it. If you have, by the way, if you haven't run into any issues, you can email me right here. It may take me a little bit of time to get to it because I get hundreds of emails every day, most days anyway. Well, maybe not 100, dozens for sure. Anyway, you can email me there and I'll do my best to help you out. But that's how you sign up for the newsletter. Okay, so our 5 questions today, we're going to start with one that I get a lot. And it's basically my thoughts on hiring folks for financial advice. The question was, what are your thoughts on hiring a financial advisor? How do you think people should choose one and understand the cost versus value of all the options out there? So it's a really good question. And so let me give you a few thoughts on it. First of all, as longtime viewers know, I'm generally opposed to the fee structure that a lot of financial advisors charge, where they charge, say, 1% of the amount of money they manage for you. So maybe they manage a couple of IRAs and a taxable account, and they're going to charge you 1% a year based on the amount that they manage for you. So for example, if they manage $1 million, that's $10,000 a year, just as an example. Hang on, turn down the volume, there we go. I'm generally opposed to that. 1% may not seem like a lot, although when you actually translate it into a number, particularly if you've got a fairly healthy retirement savings, it's a big number. And when you compound the cost of that over 10, 20, 30 years or longer, it turns into a big pile of cash. And there are plenty of financial advisors out there that will either charge just a flat fee, sometimes it's hourly, sometimes it's a flat fee, or they may charge a percentage of assets under management, but it's much, much lower than 1%. I like to see it at least under 0.5%. And there are advisors out there that charge that much or less, but I would say that the standard is 1% or more. And it's those kinds of arrangements that I think we should avoid. Now here, if you're going to hire a financial advisor, I think the first question though is, what are you hiring them for? And there are usually sort of two, I'll call it 2 general buckets. One is you want some sort of financial plan. You have a specific question or series of questions. Maybe you're retiring and you want to know, when should you claim Social Security? Should you buy an annuity? Should you roll over your 401k to an IRA? How should you invest it? These are generally one-time questions. Maybe you do a review every few years, but of course, once you decide to take Social Security at a particular age, well, you've made that decision, it's behind you. So these are not the kind of things that I think anyone should be paying 1% a year to an advisor for. These are the kinds of things that you can pay an hourly or perhaps a fixed rate advisor to do a financial plan for you, help you understand these questions. Maybe Roth conversions is another one. Get those answers. Maybe you need a phone call every couple of years if something changes in your financial situation. But other than that, it's generally just a sort of a one-time thing with an occasional follow-up. And you shouldn't be paying a percentage of your wealth for that kind of advice. It just doesn't make any sense. Then there's investment management. And this is where the 1% fees often come into play. And here you want someone to actually manage your investments. Now, there are a couple of ways to do that. You can get advice from someone. They can actually lay out an investment plan for you, but you still manage it. You actually go into your own accounts, you buy and sell whatever ETFs, for example, they recommend, but you do it yourself, but you do it with the help of this individual. And for those kinds of arrangements, again, it's not a percentage of assets under management. It's usually an hourly or fixed rate fee, and I think those can be very beneficial. If you actually want someone to take over your investments and do all of the work for you and rebalance, that's when the 1% advisors come into play. But even there, you can find folks that will charge an hourly fee or a fixed rate flat fee, and I think generally those are just better. Now, I'll give you some examples in just a minute. The other thing I would say, though, and this is part of the decision you have to make, do you want someone who's just down the street, you get in your car, you drive down there, you look at them face to face, you have a conversation, or are you okay working through Zoom calls over the internet, maybe email? That's a big decision to make as well. Obviously, if you want someone near where you live, it's going to limit your options. It could be harder to find someone within your area where you live, depending on are you somewhere out in the country with not a lot of options, a small town, or are you in a big city where maybe you have a lot of options? But that could limit your options. But I do think it's an important consideration because I know a lot of folks want the comfort of someone they can meet in person once a year to talk about their finances. I think that's certainly understandable. Having said all of that, I do maintain a list that I really want to add to it. I've got several that I want to add to it of investment advisors. You'll notice they're all men. I am looking for women to add to this. I've had a few recommendations, but I didn't find their fee structures appropriate. They were all charging 1% or more. But if you know of flat fee or low cost advisors that you would recommend, please email me. I'll add them to the list. I will say a couple of things about this list. One, I have no financial connection with any of these individuals. They're not paying me to be listed here. I don't make any money at all of any kind, no compensation whatsoever if you hire any of these individuals. That's number one. Number two, some of these individuals I know fairly well. I've worked with Mark Zorrell. I've known Rick Ferry for, goodness, a decade or more. See him at the Boglehead Conference. I know John from the Boglehead Conference. Some of these individuals I don't know. I've just gone to the websites. I see that they're flat fee. And I've added them to the list. But the point is, you need to do your own due diligence. Don't take these as recommendations from Rob Berger. Take these as possible considerations. You need to do your due diligence. I'll leave a link to this page below the video. The other thing I would say, if you're going for investment advice, whether you're going to continue to manage your investments on your own or turn it over to an individual to manage for you, you want to understand their investment philosophy. What I find is that for flat fee and low cost, maybe hourly advisors, they tend to recommend low cost index funds, a simple portfolio, 3, 4, 5, 6 investments, and that's it. It's interesting to me that when you start to get into paying someone 1% of your wealth a year, that's when I start to see portfolios with sometimes dozens of ETFs, expensive, actively managed funds, what looks like a really, really complicated portfolio. I think sometimes, this is just my own view, that advisors do that to try to justify the expense. If they're charging you 1% a year but putting you in just 3 or 4 low-cost index funds, I think clients could start to wonder, what am I getting for the money? And so they often put you in complex portfolios. I personally would avoid that. So that's sort of a quick answer to that question. Obviously, there's going to be a lot more that you'll want to consider, but that's my sort of quick take on question number 1, hiring a financial advisor. A very important question. And as I said, if you have other recommendations for that page, please send them to me. I'll check them out and add them if I think it makes sense. All right. Question number 2. Most of the reasons I hear for Roth conversions are related to taxes. Would there ever be any reason to do a conversion solely for keeping future Medicare premiums low? So that's a great question, and we need to sort of put it into some perspective. When we're considering a Roth conversion, a Roth conversion effectively allows you to take money out of a traditional, let's say, IRA, convert it to a Roth, and you'll pay taxes in the year of the conversion. The year of that conversion happens, the amount converted, assuming it's before tax dollars, will be treated as ordinary income in the year that you converted it. And so you'll pay the taxes. Of course, you don't have to convert it, right? You could leave it there, and then presumably you would take it out in retirement or when your RMDs, required minimum distributions, start, some number of years into the future. And so often we're trying to compare what our tax liability would be today if we did the conversion versus what we think our best guesstimate of what the tax liability would be, some number of years down the road when you pulled the money out to spend in retirement, or perhaps because of required minimum distributions. And so as a first step, we're often comparing our marginal tax bracket today with what we think our marginal tax bracket will be some point in the future. Now, the point this question, though, is an important one, because really, ultimately, what we want to know is not our marginal tax bracket. That might be a perfectly fine starting point. But what we really want to know is what our total taxes are going to be if we convert today versus if we don't and take the money out at some point in the future. Some will refer to that as marginal tax rates and say, okay, well, what's the difference between marginal tax bracket and marginal tax rates? Well, we know what our tax brackets are. I'll focus on the federal taxes. Of course, you have to consider state taxes as well, but we know federal tax brackets. We know what they are today. We can just guess at what they might be, whatever, 10 or 15 or 20 years from now. Those are our tax brackets. But depending on our income, there could be other, I'll call them taxes. Like in the question here, Medicare, we have the IRMA premium. So if you, depending on how much your taxable income is, you could end up having to pay extra for Medicare. It could affect how much of your Social Security benefits are taxed, and it could affect other aspects of your tax situation. So what we really want to know are not our tax brackets, marginal tax brackets, but our marginal tax rate. And as you can imagine, that gets complicated. But the short answer to the viewer's question is yes, we do want to consider Medicare premiums, among other things. And we want to consider them both when we're thinking about a Roth conversion today. Now, you may be too young. Maybe you're not on Medicare. Maybe you're not even within 2 years of Medicare where your income could affect IRMA when you start to take Medicare. So maybe it's not an issue today. It's only an issue down the road. Or maybe it is an issue during your Roth conversion. But the point is, you want to consider them both at the time of the conversion, if appropriate, and then when you might take the money out otherwise in retirement if you don't convert today. Now, there are programs that can help you figure that out. Prelana is one, Bolden is another. I've talked about these a lot on the show. I will show you briefly Bolden just so you get a flavor for it. This is a demo account. I know we're kind of going into the weeds, but I know this is an important issue. So I'll show you two things quickly with Bolden. Again, Prelana does something similar. But Bolden has a Roth conversion explorer, and one of the things you can say is, okay, I want to do Roth conversions, but I don't want my total income to go up to a point where I'm going to have to pay extra premiums for Medicare. And you can select which one you want. You could say, well, I don't want to pay any IRMA, so I want to select this first one here, no IRMA charge. Or you could select one of these others as, well, I'm willing to pay $70 a month per person. Let's pick this one, and you can run the optimization plan, and it will show you the conversions it's recommending, again, just based on keeping you within a certain IRMA bracket. It'll compare your optimized plan with your current plan. It'll show you your effective federal income tax rate. We talked about that, right? Tax liability. And then your IRMA fees. It shows you do have some IRMA fees here, and then they drop off. So the idea is these are the fees that we sort of agreed to when we ran this Roth Explorer. Remember, we selected one that said, yeah, we're willing to pay a little bit in IRMA. But that, of course, reduces our traditional retirement accounts. And so as a result, we can see once RMDs kick in, we're not paying any IRMA. Now, we could, of course, edit this, and we could come back here and we could say, well, let's try it with no IRMA charge. And it, of course, reruns the number. And it's apparently not showing any IRMA fees. Of course, that's based on the specific numbers I have in this demo plan. So you could play with that if you use Bolden. Again, Prelana does something similar. The other thing I would mention in Bolden is they have under Insights, right? Let me close all these. Under Insights, go down to IRMA, it will show you your current IRMA fees based on whatever plan you have. That's your modified adjusted gross income. It's not showing any IRMA now at the moment. Again, that's just based on the data I have in this plan. But if you were going to incur additional Medicare premiums, they would show up here. So there you go. I do think with this kind of calculation, it's helpful to either use some software. Bolden is just one example. Or perhaps talk to a tax or financial planner. The calculations can get complicated. I find using software like Bolden to be helpful. All right, great question though. All right, question number 3. Once you start taking Social Security, they're asking me personally, do I plan on increasing my stock allocation? Am I going to change my asset allocation once Social Security kicks in? And here's basically how I think about this question. And it's really broader than just Social Security. It's how I think about asset allocation in retirement. And it's this. For me, question one is, how much of my retirement savings do I need to pull out each year during retirement? Now, of course, as I have more sources of other income, could be Social Security, like the viewer was asking about, could be an annuity, a pension, could be part-time income, but I'm going to have some amount of income coming in outside of my retirement savings. And of course, the more income I have coming in, the less I'll need to pull from retirement savings. So, but that's the question. How much do I need to pull from retirement savings? Of course, once Social Security starts, that number's presumably going to go down, right? And so for me, when I think about how much I'm going to pull from retirement savings, if I'm somewhere around, I'll just generally say 4 to 5%. You've probably heard of the 4% rule, popularized by Bill Bengen in a 1994 paper. I've talked a lot about that in other videos, but if I'm somewhere around 4 to 5% in withdrawals, I'm going to want my asset allocation to be somewhere between 50 and 75% in equities and stock. Now, is that a guarantee that my money will last at least 30 years, as Bill Bengen concluded in his 1994 paper? No, it's not. What he found is historically it would last at least 30 years with an asset allocation somewhere between 50 and 75% in stocks. There's obviously no guarantees for the future, but I think it's as reasonable a result as we can sort of arrive at given what we know. In my case, I prefer to get as close to the 75% in equities as I'm comfortable, which is basically where I am right now with our asset allocation. Now, to the viewer's question, once Social Security kicks in, will I change it? Well, in our case, it depends on just how much Social Security will matter. So for example, let's just imagine you're at 4.2% taking out of your retirement account, and it's going to drop you to 3.9. I'm just making up numbers. It probably wouldn't change a lot. But let's say Social Security was going to be a significant part of your retirement income, and it took you from, again, I'm just making up numbers, 4% to 2%. Well, then that gives you a lot of, I think, options with your retirement portfolio. Because you're only withdrawing 2%, I think it's probably safer if you wanted to increase your stock allocation. The idea, I think, there would be, look, I'm spending a relatively small percentage. I'm assuming we're retiring at traditional ages, let's say in our 60s. Maybe you start taking Social Security at 70 as an example. I'm not spending a lot of our retirement portfolio, which means I'm really leaving it for charities or loved ones when I die and I want it to grow. I'm not needing much of it each year in retirement, so I might be more comfortable perhaps even going above the 75% stock allocation. In that situation, yeah, Social Security or other forms of income that might start at some point in retirement might indeed change my asset allocation a bit. But if it didn't make a big change in how much I was spending out of our retirement accounts, then it wouldn't. That's at least how I think about it. All right, great question. All right, that was question 3, I think. Question 4. This comes from VJ. He's from Michigan. I like VJ. We actually got to meet once in the real world. Okay. How do you and your spouse invest in 401k, IRA, Roth, taxable accounts if you have variable or unpredictable income each year? That's a great question. And I know, we often get that question not only in terms of how do you invest, but how do you budget when you don't know your income from month to month. Right now, my wife and our income is variable year to year because it comes from things like this YouTube channel. And so, yeah, it absolutely varies from month to month and from year to year. And here's the way I think about it. The issue in terms of how you invest when your income is variable is that from one year to the next, you don't know how much you're going to need to draw from your investments. You may have some rough idea. It may be a range. Maybe some years you don't need to draw from it at all. You've got a side income in retirement, maybe a part-time job or side hustle plus Social Security and a pension. And maybe some years you don't need to take anything out, but other years maybe you do. Or if you haven't retired yet, you may need to pull out some money you'd saved previously just to cover your expenses because maybe your income is down one year as compared to the previous year. And so The way I think about this is simply I manage it through an emergency fund. I think the more variable my income is, the bigger an emergency fund I'm going to want to have saved, typically for me right now in T-bills. They're fairly tax efficient. You don't pay state and local income tax on the interest. And they're about as secure an investment as we're going to get in this life. The yields are reasonably good, certainly comparable to, say, a savings account or a short-term certificate of deposit, or maybe a money market. I think money market funds could be good options as well. But the more variable my income, the more I'm going to want to save in an emergency fund. And I think the amount just depends on just how variable your income can be from year to year. Maybe it just fluctuates 10 or 20%, but maybe it fluctuates 50 or 75%. You're going to need a bigger emergency fund. In our case, I'm just comfortable having 1 year's worth of expenses, and that gives me plenty of time to prepare if the income should fall below what I expected, or maybe 1 year it goes up. And either way, that's just sort of my comfort level. What will be comfortable for you, of course, will no doubt vary. But 1 year, I think it will give me enough time to adapt to any changes that I see in our income. And once I have that, then I can go ahead and invest my accounts in my asset allocation plan without too much concern. In our case, it's roughly 75% stocks, 25% bonds. And I take some comfort in that 25% bonds as well, because that's fixed income. It's relatively safe and generally not particularly volatile. And I know that I could draw on that as well if I had to. So VJ, that's at least how I think about that question. All right, our last question, this is an easy one. They want to know if I plan to rebalance our portfolio by selling U.S. equities and buying international stocks. Why? Because U.S. stocks far outperformed international stocks. And I can actually show you this real quick. We'll take a quick look here. So this is, let's see here. I'm just showing you the Apple stock app, and everything's down today. Boy, this is ugly. Anyway, if we look at the S&P 500 year to date, you probably can't read that, but it's around 25 to 26%. That's U.S. stocks. That's what they're up. We can look at VTI, which is the total market. It's up 24.5% year to date. So that's U.S. stocks. We'll just call it 25%. VXUS, which is a total international stock fund. Listen to this. This is ugly. 3.66%. Wow. 3.66%. So the short answer to your question is yes. Not only am I going to effectively sell U.S. equities to rebalance, I already did. I did it a few weeks ago when I was simplifying our investments inside of our traditional retirement accounts. I saw that U.S. stocks had grown relative to my plan, and so I did. And this is the thing to understand about being diversified. Whenever you have a diversified portfolio, there will always be some asset class that's underperforming some other asset class in your portfolio. That's just the sort of the bargain. It's what we accept when we diversify. And I think what a lot of folks do, particularly when an asset class underperforms like international stocks have, for a number of years in a row, they grow weary of that. They just get tired of seeing that underperformance, and they see other people on whatever, X or Reddit or Facebook, talking about how their US stocks or their Bitcoin or their tech stocks are on fire and how much money they're making. And I think it can cause us to sort of really say, I'm not sure about Rob and his international stocks. This isn't making much sense to me. But when you take a much bigger view of the history of stock markets, asset classes, investing generally, what you realize is all of these things go in cycles. And yes, international stocks have underperformed U.S. stocks for, 13, 14 years now. The first decade of this century, international stocks outperformed. But since, the Great Recession and a few years after that, U.S. stocks have beat them by quite a lot. But I believe that that's not going to last forever. And I'd just as soon be diversified, recognizing that, yes, for some periods of time, my international stocks, like this year, don't look so good. I'm willing to pay that price for the benefits of diversification. I would just say for those that are just, no, I like U.S. stocks, and you maybe invested, the S&P 500, I would say, well, if you're going to make an investment based just on what's outperformed on the last whatever decade or so, why do you own the S&P 500? It clearly hasn't outperformed. Why not go with QQQ or some tech stock? Or for that matter, Bitcoin? I mean, at some point we have to ask ourselves, how much diversification are we willing to get rid of to focus our portfolio on a specific asset class because it's done well over whatever the last decade? How much risk are we really willing to take? Because you can always just keep going. Don't stop at the total U.S. market. Go to the S&P 500. Don't stop at the S&P 500. Go to just tech high growth stocks, right? Don't stop there. Just go to the Magnificent Seven. I mean, we could keep going. And each step we would look back over the last 10 years or so and see more and more and higher returns. But of course, each step we take, we're shedding some diversification, and I think setting up our portfolio for a pretty significant loss at some point in the future. Now, some could say maybe I'm not diversified enough. Maybe I need to have even more international stocks. I guess at the end of the day, we have to kind of arrive at a place where we're comfortable. In my view, that point should be where you're comfortable staying for decades. And that's at least what I try to accomplish with our portfolio. Well, there you go. Some great questions this week. And I hope you have a great week. There will be another live show January 6th, and there should be another 5-question Friday a week from today. Hope you have a great week. And until then, remember, the best thing money can buy is financial freedom.